For as long as most of us have been investing, there's been this one simple rule. If you want big growth, you buy small companies. It's this core belief, right? That smaller, scrappier stocks are just destined to run circles around the big, bulky giants. But what if that's all wrong? What if the game has completely changed? Well, a massive new data analysis is suggesting just that.
Okay, so here's how we're going to break this all down. First, we're going to tear apart that small cap myth. Then, we'll dive into the huge quality and safety gap the data is showing us. We'll uncover where the real growth is hiding, then get to the shocking reversal in stock returns, and finally, we'll lay out a totally new game plan for investing smarter in the market we have today.
All right, first up, let's tackle the big idea, the theory that has literally shaped countless investment portfolios for more than 30 years.
So, this whole idea has a name. It's called the size premium. It comes from some of the biggest names in academic finance, Fama and French, who pointed it out way back in 1992. And the idea is pretty simple. Smaller companies are riskier, so investors should get paid more, get higher returns for taking on that risk. For a whole generation, this has been the bedrock reason to own small cap stocks. But here's the billion-dollar question, right? Does this theory, a theory born in the early 90s, actually hold up in today's market? All the evidence is starting to point to a really dramatic shift.
Well, according to this massive deep dive by their research team at Finstill, they looked at over 1,600 stocks. The answer is a huge, resounding no. In fact, the data shows the complete opposite is happening now. Large companies are absolutely dominating on almost every single metric that matters. How profitable they are, how financially healthy they are, and yet, even how their stocks perform. Okay, so let's dig a little deeper. We're going to look at the fundamental quality and, the financial safety of these companies. And this is where the story gets really compelling.
Honestly, the data here is just crystal clear. As you climb the ladder from the tiniest microcaps all the way up to the megacap giants, the quality of the actual business just gets better and better in this really consistent, almost perfect way.
Now, what's really wild on this slide is just the sheer scale of the difference. Just look at return on invested capital, ROIC. The typical megacap company is earning over 14%, while the median microcap is barely squeaking by at 1.7%. That is an 8 times difference in how efficiently they use their money. But this is the real shocker. Net profit margin. A typical megacap company turns 21 cents of every dollar of sales into pure profit. The typical microcap, they make 0.2 cents. For all practical purposes, they are just barely breaking even. That fact alone should completely change how you think about looking for stocks. Okay, now check this out, because it's kind of counterintuitive. You'd think, oh, small companies are safer because they have less debt. And it's true, they do have less debt. But it's not a sign of strength, it's actually a sign of weakness. The big guys can get cheap debt anytime they want to fuel their growth. A lot of small companies can't get that capital at all. So their low debt isn't a choice, it's a constraint. And this chart, it just perfectly illustrates the real-world risk we're talking about. We're using the Altman Z-score here. It's a classic way to measure bankruptcy risk, and it shows that over half of all microcap stocks are in the financial distress zone. Compare that to less than a third of megacaps. So if you're a small cap investor, you're basically navigating a minefield of really fragile companies.
All right, so less profitable, less safe, but hey, the whole reason to own them is for that sweet, sweet growth, right? Well, yeah, about that. The data tells a much, much more complicated story than you might think. Honestly, this chart right here is one of the most surprising things in the whole analysis. If you look at the median company, the typical growth rate, it's actually the mega caps that are growing the fastest, 7.1%. The average small and micro cap are growing way, way slower. So you're probably thinking, wait a minute, where is this legendary small cap growth premium I've heard so much about my entire life? Did we all just make it up? And the answer is, it's all in the extremes. The growth premium isn't in the average small company, it's concentrated in a tiny, tiny fraction of superstar performers. The top 10% of microcaps are growing at a mind-blowing 45.9% a year. So yeah, that hypergrowth is real, but it's a total needle in a haystack. The challenge isn't just to buy small, it's to find that microscopic group of elite winners. All right, this brings us to the main event, the bottom line. We've seen the gaps in quality, safety, and growth, but how did this all translate into what we all really care about most, actual stock price returns?
And here it is. The size premium hasn't just gone away, it has completely, violently flipped on its head. Over the last 5 years, the bigger the company, the better the return. It's like a perfect, brutal downward staircase, with mega caps more than doubling your money, while micro caps have been an absolute train wreck. I want you to just let that number sink in. Negative 44.7%. That means the typical person who bought a typical microcap stock 5 years ago has lost almost half their money. This isn't just underperformance. This is wealth destruction on a massive scale for an entire category of stocks. And this isn't just a bad 5 years, okay? The researchers at Finstill point out that this is a deep structural pattern. It's being driven by massive trends, like the flood of money into passive index funds that only buy the biggest companies, and changing credit markets that hammer smaller, weaker businesses the hardest. So, with all this evidence staring us in the face, it's pretty clear the old playbook is broken. The big question is, what do we do now? How do you adapt to this new reality where bigger is actually better? Look, the big takeaway here isn't never buy small caps again. No, it's stop buying them blind. You have to filter aggressively for quality. That means using simple screens like the Piotrowski F-score to check for financial strength, making sure they actually generate cash, and using the Altman Z-score to weed out the bankruptcy risks. If you just apply these simple quality filters, you can clear out most of the junk and focus on that small group of potential winners. So a really smart way to put all this together is what's called the core satellite approach. You build a strong, stable foundation of your portfolio, that's your core, with high-quality large-cap companies. Then you use a smaller piece of your portfolio, your satellite, to make those very targeted bets on the carefully filtered high-growth small caps. It lets you have the best of both worlds, stability from the big guys and that explosive potential from the little guys. And all of this incredible data, it comes directly from the research team at Finstill. If you want to go way deeper, you can find the entire report on their site. And get this, they've also got over 300 free learning concepts explaining finance from the ground up, plus tools that let you apply these exact filters yourself. It is an amazing resource, so definitely follow them for more data-driven insights just like this one. And that really just leaves us with one final thought. One last question for you. The data is screaming that the market of today is not the market of 1992. The old rules are out the window. The only question left is, has your strategy caught up?